Happy Wednesday out there, Team 42. It's your skipper here, Darius Dale, to present our macro minute for Wednesday, January 17th, 2024. As always, if you did 3, 2, 1. Happy Wednesday out there, Team 42. It's your skipper here, Darius Dale, to present our macro minute for Wednesday, January 17th, 2024. As always, if you would like the damn it, tripping. 3, 2, 1. Happy Wednesday out there, Team 42. It's your skipper here, Darius Dale, to present our macro minute for Wednesday, January 17th, 2024. As always, we'll start with the executive summary from today's lead-off morning note. If you would like the analysis supporting these conclusions, as well as what to specifically do about them in your portfolio, you need to be a client of 42 Macro. So we'll start with today's key macro event, which is global macro fundamentals are getting increasingly messy. The nuance there is that the new news embedded in the latest batch of key high-frequency economic data is that the U.S. consumer is defying consensus expectations of a sharp slowdown beginning in Q4. That news favors the no landing scenario at the expense of the soft landing consensus that is currently priced into asset markets via the Goldilocks top-down market regime. From a market implications standpoint, in risk management terms, a no landing in growth but not inflation increases the probability of a phase transition to a risk-on in reflation top-down market regime. Any such transition may be fleeting, as we view the risk of the U.S. economy experiencing a no landing in growth only and not inflation as unlikely. As such, we continue to anticipate a row phase transition to inflation. Row just means risk on or risk off, or vice versa. We anticipate a phase transition to inflation as the most likely destination for asset markets if any such change occurs in the short to medium term. The jury's still out on that in terms of the signals. So we'll transition to our 42 macro dashboard, getting a couple of oversold signals here from our trading ranges from our friends over at Longbow. DBC is the broad commodity basket there that is currently oversold here. Just be aware of that signal. And then we're also still getting an oversold signal in the 2-year nominal treasury yield there. And then what else are we seeing? Oversold signal in Bitcoin there. So just be aware of those signals. And then lastly, transitioning to our community here, addressing a question from one of our subscribers, a question on the weather model here. So I'll just read it. It says, hi, Darius. I've been following your great work for a long time and have finally become a Macro Strategist Pro subscriber. I have a couple of questions about the data that is shown in the weather model that I hope you can help understand. More specifically, how should I interpret the next 12-month real GDP growth delta figures? In the latest morning note, the model output showed a decline of 110 basis points. Does this mean the consensus forecast among economists for growth in 2024 has declined by 110 basis points? If so, during which time frame? Same question for CPI. I hope I'm not asking for secret sauce to the model. So thanks for a great product. Great question here. So just helping investors understand our weather model signal. So that's one of the principal components of macro that are featured in the weather model. That's one of the component features of those 10 principal components of macro, specifically the growth component. And with respect to the next 12-month real GDP growth delta calculation, what that calculation is designed to do is take the consensus estimate for real GDP on a year-over-year basis to 12 months from now, and subtract the current real GDP growth rate from that estimate, either the most recently reported quarter or the estimate for the current quarter, depending on what's been reported thus far. So currently, that minus 110 basis point delta just shows that there's 110 basis points of delta between the Q1 2025 estimate of 1.1% year over year versus the Q1 2024 estimate of 2.2% year over year. So we're, at all times, the weather model is being programmed to be smart about what consensus expects growth and inflation to be in delta terms over the next 12 months, so that it's one of the 20 component features in the model that are helping the model create positive and, more importantly, accurate rolling 3-month projections for the various asset classes in terms of the excess returns and the excess volatility you should expect in those asset classes. So hopefully that makes sense. Just kind of quickly summarize. It's taking the year ahead estimate and subtracting the current estimate to calculate that delta. So we'll wrap it up there. Darius Dale presenting our macro minute for our Wednesday, January 17th, 2024. Everyone have a wonderful day out there. We'll catch you back here tomorrow, same time. Cheers.